On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice and it doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Please engage with us. We love to get feedback, questions, and comments on this material, and if you enjoy it, please rate it, or even better, share it with a friend or colleague. The 2025 edition of the UBS Global Family Office Report offers some fascinating insights into how the world's wealthiest families think about risk, time, and opportunity. UBS captured the views of 317 family office clients in this report. The average net worth of participating families was US $2.7 billion, with their family office teams managing around $1.1 billion each. Attitudes to risk, governance practices, running costs, staffing, and succession planning were all covered. However, it's where they put their money that really interests me the most. At a very high level, the average asset allocation, and the asset allocation simply means the mixture of the different asset classes like shares and bonds. At a very high level, the average asset allocation isn't too dissimilar from that of a typical New Zealand managed fund, in the growth category, that is, or an individual investor with a comparable risk profile. But there are some key differences, and the most obvious is the 33% allocation that wealthy family offices have to alternative assets. Now, there's no official definition of what this category includes, but it's generally thought of to be anything outside the traditional investment classes, which are shares, bonds otherwise known as fixed income, and cash. So anything outside of shares, bonds, and cash. Real estate is often included in alternatives, and it's 11% of family office portfolios. But I'm going to focus on the other components, as many people in New Zealand already have a real estate exposure. Now, excluding real estate, the rest of that alternative assets bucket includes private equity, private debt, hedge funds, art and antiques, gold, commodities, and infrastructure. If you're like me, you would include classic cars with art and antiques. Private equity represents the lion's share of this at almost 2/3 of the alternative assets and 21% of the total asset allocation. Now, private equity simply means holdings in unlisted businesses, as opposed to listed equities that anyone can buy on the share market. Private equity offers the potential for higher returns, as well as a much wider range of investment opportunities. However, fees do tend to be higher for these types of investments. They can be complex, and they often need a much larger minimum investment. Private equity can also be very illiquid, and that means you can't sell your holding quickly or easily should you need to. None of these things are likely to bother the typical family office though, and an extended investment horizon is usually a feature of their approach. That's a key advantage that the uber-rich often have, their ability to take a much longer term view. They think and they invest in a truly intergenerational manner, which means their approach is probably closer to that of the New Zealand superannuation fund than a private individual investor. The other 12% is spread across the remaining alternatives, with private debt and hedge funds the biggest at 4% apiece. That overall 33% allocation to alternative assets comes at the expense of listed equities, which average a 30% weighting. Add those two together, 33% and 30%, and you're pretty close to that 70% weighting that the average KiwiSaver growth fund has to equities. Beyond that, the family offices have 19% in traditional fixed income or bonds and another 6% in cash, which is pretty close to our managed fund averages of 13% and 9%. That's according to the Sorted website. So the big difference here is really that hefty weighting to alternatives, which tends to be dominated by private equity, and it also includes the likes of gold, infrastructure, and private credit. For those investors looking to take a leaf out of this book, these types of assets aren't nearly as unattainable as they once were. There are diversified alternative asset funds available across the local market that are managed by global specialists and structured in a tax-efficient manner for New Zealand investors. Now, I can't stress enough that if this is something that interests you, you really do need to get some advice and talk to an investment advisor to make sure these sorts of assets are appropriate for you. But overall, while few of us have billions to invest, we can still learn from those that do, especially when it comes to thinking long term and looking beyond those traditional markets. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.